All right, so this is the COVIDeo series with Food Co-op Initiative, and the topic today is the future of, now we made it short, so it said the future of lending. Christina Jennings, our featured speaker, did not promise that she can speak to absolutely everything about all kinds of lending going forward. It's that I didn't have room to add the words with startup food co-ops. So I just want to say she didn't promise to talk about all of it, just stuff that's related to us. This is, as you guys know, this is being recorded. So just keep that in mind with what you say. Please do mute unless you're talking. Because we have enough people in the room, if you have a comment or question, please throw it in the chat. And I will throw those at Christina as she's ready to take them. And Christina, are you wanting any chance? I forgot to ask you beforehand, do you want to kind of take them as they come, or do you want them all saved to the end?
I'm happy to take them as they come. If there's some things I feel like would be helpful to get through, I'll let you know, and we can hold them for a minute. But let's start with taking them as they come.
Okay, terrific. All right, so you guys, this was one of the most requested topics. We got the most requests for this one and from the market study one. So we have finally gotten around to it, and I'm really grateful to have Christina Jennings, the Executive Director of Shared Capital Cooperative, with us. They are based out of Minneapolis, but they serve nationally, and they lend specifically to cooperatives all over the United States, through most United States regions. And full disclosure, I am on the board of directors there. So I was a little biased in choosing Christina, but I think she's gonna have a lot of great things to share with you all. And I'm gonna turn it over to Christina.
Great, thanks, Jacqueline. And great to see and be with all of you. And just quickly, I'll just spend a couple of minutes giving you information about who we are. I know some of the folks and co-ops on the call, but just so that others know who we are and what we do, and then we can talk more broadly. So, and sound okay? Just checking my microphone sometimes works better than others. Okay,
your sound's great.
Great, perfect. So we are Shared Capital Cooperative, was actually founded back in the late 70s as a cooperative to serve cooperatives. We're actually founded by food co-ops, recognizing that they often had trouble getting money back in the day, as many of you know, you still do today. So we were founded by a group of 5 food co-ops in Minneapolis, St. Paul, who pooled together. I just love the number. So like 75, what in today's dollars would be $7,500, and created a revolving loan fund so that they could get access to capital when they needed it. Recognizing that they weren't necessarily getting it from banks. And today we have about 250 co-op members. We are a cooperative of cooperatives with 250 members of all different types of cooperatives. Food co-ops are a very large part of our membership. We also work with worker co-ops, purchasing co-ops, housing co-ops, and some small farmer co-ops. What we do is we pool money from our cooperative members and from other social investors who cooperatives, and then we make loans to co-ops. And as Jacqueline said, we do work nationally, though we're based in the Twin Cities, Minneapolis, St. Paul. And we have historically worked with more growing co-ops than startup co-ops. And we have always worked with some startups. And it is, I'll just acknowledge that it is for many funds like ours that can be more of a challenge, but we'll talk about that. So I'll start with that. Let me think, did I forget anything? Yeah, we make loans to the startup food co-ops we've worked with in many different communities, helping finance everything from inventory and equipment or leasehold improvements. Sometimes we're the lead lender, providing most of the outside financing, and sometimes we're working with a local bank or the National Co-op Bank and helping kind of fill a gap that that bank isn't able to make. So we kind of work in both ways. There are other great loan funds around the country. We work nationally, but we generally don't work in New England because there's a great fund in New England. For those of you there, you probably already know the Cooperative Fund of New England. And we work often with them as well as with our partner, Local Enterprise Assistance Fund. We work with quite a lot as well. So just to acknowledge those other resources. Among others.
And Maggie's actually in the room from the Cooperative Fund of New England, so she may jump in some of the comments as well.
I was gonna say she may have some great answers for some of the questions that come up.
You did mention that we started at $7,500. What size? What kind of fund are we now? What size? How many loans we do?
Yeah, we have about just under $14 million, and our portfolio is over 85 loans to co-ops. Over our lifetime, we've made over 850 loans to co-ops, a large portion of those being food co-ops. So some food co-ops getting loans from us more than one time, as you can imagine, given that number.
Oh, including my home co-op. Okay, excellent, thanks.
Great. So do you want me? I'll start off with a couple of comments and then take questions, or do you have anything you wanted to frame first?
Do you have some ideas or thoughts you want to lay down, or do you want me to ask you questions? Because I got plenty.
Sure. If you've got questions, we'll start with those, and I'll add in as needed.
Okay. Well, guys, go ahead and throw your questions in the comments if you want. I'm going to kick off with one of mine that I've heard from a lot of you, which is, of course, lending just for startup food co-ops was already becoming much more difficult. Before COVID-19, there had been this sense for a year or two. I mean, at some point we had a moratorium that shared capital for a short period of time. And a lot of lenders who usually work with startup food co-ops or have repeatedly worked with startup food co-ops were being a lot more cautious about lending to them. So overall, I think there's this question in the air: is what's happening now, COVID-19, what's happening with the protests and so forth, is that going to further constrain the kind of lending dollars you think that are available to startup food co-ops?
I mean, you're really talking about sort of three different levels of uncertainty and challenge. So first and foremost, I think starting in about 2016, we started cutting back on some of our startup food co-op lending because we were starting to see some co-ops really struggling with competition in their marketplace being really intense, and the ability to really succeed as a startup being challenged. Recognizing that some of our assumptions about what supported success in the past were no longer true, given the new kind of competitive landscape that folks were facing. And if we don't, and our, I guess I'd say in terms of over lender, our game, unlike say a venture capitalist puts out money to a whole bunch of projects and hopes to have a huge windfall on a few of them. Lenders, we play a more conservative game. We're looking for projects that are very likely to succeed. And why? Because I mean, in our case, and I think in the case of many loan funds like ours, we're actually borrowing most of the money we pay it. In our case, to our co-op members and to other investors, our money is not ours to play with and see what we can succeed. We'd love that. That's not the way it works. So we're trying to make the best guess about how we can get our money repaid, so that we can repay our obligations, and that limits sometimes the risk. So, on the one hand, you had this changing competitive landscape for food, for grocery in general, for retail in general, and impacting startup food co-ops. Sure, you all know well about that. It's been the landscape you're operating in. Now we layer on that COVID and all of its craziness and uncertainty, and also and also recent protests, and then a lot of speculation about upcoming recession and what is likely to happen. With the recession, one of the questions is how that will affect availability of capital from banks and others. Typically, during recessions, banks tighten up their lending. They make fewer loans. They're more cautious about their loans. They make lower risk loans. They won't take the risk they might have taken in good times. So you've got all of those factors, and I think the short answer is that uncertainty is, it creates a lot of challenges. I think we were already trying our best to, so we had scaled back some of our startup lending, and we're really trying to make sure we were making the best guesses about who could succeed. Now, whether those were always right, we could do the best we can with the information we have. With COVID, I think none of us know exactly how this is going to play out over the next several months and over the next 18 months. And understanding how that affects your margins, and in some positive ways you may drive more business, and in some negative ways it may really hurt your margins. Trying to assess that, and then of course the uncertainty of recession, and is everyone going to be tightening their belts over the next 12 months or so? Who know? Your guess is as good as mine. I don't claim to have economic forecasting abilities, but I certainly hearing the talk about that. So I think the answer is it is probably going to be even more challenging right now. The flip side is it's also, you all have been classified as essential businesses. So grocery is really important, and I think you're getting the recognition that you deserve, which is that we need to make sure communities have access to grocery. Plus the fact that there's I think there is some revisiting of what makes a difference in, there's maybe a heightened interest in local business in many communities that may support your success. But so lenders may be pulling back, but maybe there are other resources that can really support you.
That leads to an interesting question. So you were saying, you know, that the recession, I think you spoke to this, recessions actually tend to be decent for grocery stores, sometimes very good for grocery stores. And if any of you were at the CCMA talk yesterday, C.E. Pugh, who leads the National Cooperative Grocers, pointed to some food co-ops right now are experiencing immense success because and after the bulk buying of early COVID-19 continue to see immense success. Those that were already having operating problems are continuing to see them, and some that were doing great beforehand are doing worse. And so it's balanced out. About half are doing, you know, are seeing growth and since COVID-19, and half are seeing more lost sales. But it sounds like in banking, it's pretty universal, because banks are very different than CDFIs. And we're not too much in the basics here. That's why we offer all those classes that have been coming and stuff. But they are different beasts, and they're under different regulation. Do you see this situation affecting everyone by becoming more conservative with lending within the lending world, the different types of lenders? Oh, you're muted.
Yes, your point is a good one. Grocery certainly has been able to weather some recessions really well, to a degree which the business is prepared to do so. Like lenders, I think I'm particularly talking about banks and some to lesser degree credit unions, and thinking about the impact of recession as a tightening of lending. Usually, as a CDFI, so we are a community development financial institution, or CDFI, and that is a certification from the U.S. Department of Treasury. Basically says we're a lender and we provide financing primarily to communities that have have had more limited access to capital. And so that's the sort of basics of what we as a CDFI and the Cooperative Fund of New England and LEAF are also CDFIs. And as CDFIs, actually in some ways we are also somewhat countercyclical. We can be, in that sometimes more money is coming into CDFIs to support our lending because there's a heightened need, and because banks are are unable to meet that need. That is not always a guarantee, and so it really depends on, because often in order for that to happen, it means that the federal government has to decide that they want to channel more money to support small businesses through CDFIs, and so if they do that, we can. And so in some administrations that's and economic crises that has worked, and in some it has not. But I guess I would just, maybe you also asked about risk, and I think there can be similar sort of I think the economic uncertainty can cause CDFIs to take more cautious approaches as
Uh-oh, you froze on me. You're still frozen. Is that, it's not just me, right? She's frozen? Okay. You completely froze, Christina. And you were freezing like for a second here and there, but now you're completely frozen. You may have to actually leave and come back. Yeah, I'm gonna suggest that you try that. That you try hanging up and calling back in, because you completely frozen and it's not recovering. While we see what's going to happen with that, we do have, so I'm going to pick on some other people who are on the call. I did mention, you know, that Don Moffitt is on the call from Cooperative, and Maggie Taylor is on the call from Cooperative Fund of New England. Cooperative Fund of New England, as Christina pointed out, is another CDFI lender that works with lots of startup food co-ops, specifically in the Northeast. So I will not put either of you completely on the spot. I leave it up to you. But if you have any thoughts you want to share on what you think is going to happen with the tightening of lending and CDFIs, you know, things that will specifically affect startups.
But I want to ask Maggie to follow up on her comment in the chat.
Me? Follow up my comment in the chat? So my comment in the chat is that what we're talking about now at CFNE, and I'm sure CDFIs across the country are starting to have this conversation, is in more challenging times, because we, for the most part, do have people who invest in us or lend to us, and we have to repay them. So how do we accurately analyze or underwrite a loan applicant, a food co-op or anyone, so that we can be pretty clear that we are not taking on too much risk, but continue to sort of meet our mission of lending into communities that have historically and continue to be sort of ignored by banks. Sort of looking at now, Jacqueline, you're muted.
And I'm glad you're here, Maggie, because my internet just went down for a minute. So glad you're.
Well, and
I was called on.
yeah, I called on her to fill in some space there. I'm having all sound issues. Is everyone as well? That is not for. All right.
You're echoing.
Yep, as you are too. Christina's not. So I'm gonna let Christina talk. You can see Maggie's comments in the chat about some of the challenges the CDFIs are facing because they need to stay mission to be able to do mission lending. But the situation has definitely changed. So talking about how to do underwriting differently, so forth. Do you think there's a conversation there as well, and that what can startups maybe expect to see based on that? I was throwing to you, Christina.
Yeah, that's a great question. I think in some ways, maybe I'll almost speak to just even where we were pre-COVID. I feel like because everything else is sort of just add on to that. I think what we were seeing is just really trying to make the best assessment we can about the likelihood of success. And that is challenging because there's not a lot of data right now to support this new kind of phase we're all in from a grocery standpoint. Market studies aren't necessarily reflecting where the market is today as much as they do in certain ways, but there are limitations. And so we can't look back at the last 20 years and think that's going to inform what will be successful today. And I think that's really where the challenge is the best indication of likelihood of success is looking at past experience. As a startup, you don't have that to show, and the grocery sector can't necessarily demonstrate what past practices have necessarily been successful as guaranteeing they'll be successful today. So that means that we do a lot of we're going to be trying to look at a lot of things about like how prepared you are. Do you have the best resources helping inform your decisions? And do you have a team that's incredibly committed to making sure that to working through whatever challenges that come up? And I think that's where CDFIs, rather than something that CDFIs can do that maybe a bank is going to have a lot harder time doing. They're going to want to see the financial. They're going to want to be able to rely solely on the track record or market study indicators, and you're gonna have a hard time kind of giving that kind of precision. If we can instead look at your team, look at your membership base, look at the success in raising money from your members and raising members, getting members on board, and the strength of the team, of the consultants and team you've brought around you is just often for us an indicator, in part because one of the indicators is that if you run into trouble, do you have people to turn to, and do you have you proven that you will turn to other people for help and not just assume you can solve every problem on your own. I think that for many of us as lenders, that's what we talk about. It's like, we want to see that you're going to listen to other people. You, and by you, I mean the collective group, that's the organizers and board. So those are some of the things we're looking at that can help mitigate that financial uncertainty of trying to look at market studies and projections and all of that.
That leads to an interesting question. Market studies. So we already know pre-COVID-19 that we were seeing more variance from actual performance than we had in the past in market studies. And now we had a session on market studies. I don't know if you got to, that was with Debbie Sosuna, and she said, and we talked to other providers since, that one, we don't have any data to work off of about what post COVID-19, and we won't for a while. And so we're not going to go ahead and make up data. So yeah, we're going to do them the same way we've been doing them. And that two, but not to like bet the bank on this necessarily, but we've not seen in previous downturns that there's been a major negative effect on market studies, because grocery continues to stay stable or even to grow as an industry, usually through downturns. So that said, and I'm not looking necessarily for put you on the spot to say if you agree with them, but you guys, I think you said, well, we're going to need to look at things in addition to market study, and I'd like to go a little more depth on those, but market studies are still important, right? You're still going to expect to see them, and that people are basing their finances on those, or what would you say about that?
I mean, that's right. I mean, the irony is I think we still want you to have a good market study, as good as you can get, and we're going to look at it and probably, I don't know, we might cut it back to 25, we might cut your projections back to 25% and see if you can still repay us. And a variety of steps in between that. So yeah, market studies are still important, and right. I mean, in some ways, it could be that a recession actually eliminates some of your competition who've over-invested into markets where they're not going to be able to thrive. I mean, it's possible, right? But we don't exactly know that. So that I'm speculating. But if we can't, on the other hand, they tend to have a lot more cash and resources. So I do think market studies are critical and imperfect, and the best I think what we're looking for you to do is get the best market study you can afford to get, and then have a really critical eye for what might not be the same in your community today looking forward and learning from each other, and then bringing the best of that thinking. And then we're going to probably still cut back your projections and assumptions even more, but have good assumptions in there to start with.
Can I add one thing that we're starting to look at is asking our applicants to provide 3 scenarios for projections, so that we can see that they're considering planning for worst case scenario as well as what they hope or expect will happen, and then maybe best case.
Yep, I would say that's a smart. It's the same advice that we would give, and to be honest, that we would have given before this, but now it's more like lenders actually expect to see it on paper. Like, yeah, we've stress tested it. We ran what would happen if our sales were 15% lower than we thought. No, they're probably really going to want to see that now that you did it. But I wanted to get through it. The market study is still critical. It still needs to be there. So there are a lot of additional factors, and I want to go into those, and you're both welcome to answer. I'll start with Christina. But the market study is still going to be core. It's still expected. And now let's say you mentioned some of the additional factors you'll be looking at: ownership growth, solid organizing team, using some of the best support and resources. And so you spoke to that a little. I don't know if you wanted to add anything else about what you'll be looking for in addition to the market study, or what you'll be paying more attention to even now, now in the current economic situation and uncertainty.
Yeah, right. So now, for better or worse, we have the experience of a number of startups that we've worked with since about 2013. We've worked with startups for longer than that, but particularly that window. Some of whom have really made it through some tough, challenging times and are doing well, and some of whom are closed. And we lost money on, we lost our members' money on. We don't, I was like, all right, well, how do we avoid those mistakes? And I think we've tried to really look at what the challenges that those co-ops faced. And I think, right, so market study was as good as it was. They varied in quality, and there's a lot of uncertainty. But what else? I think that's where we saw the co-op that's able to, follow best practices and take good advice, as I said before. That'd be one piece. 2, I would say that they are and have a sort of a learning culture, so they're learning from their mistakes and willing to gather information and figure out how to go forward. 2, I would say that they are they have strong support in the community, and the way we can assess that as lenders who are not in your community is to look at how many members have you accumulated, have you got on board in your community, and how many, and also how you've been able to raise member loans. And if those 2 things end up being sort of the proxies for what's your support, because what we're trying to see is when things get more difficult, as they may well, are you going to be able to, do you have the connections in the community, the support in the community, and the strength of the team to go back and raise more money if you have to. So if all else, because that's where some have turned around, some startups that could have failed were managed to survive and thrive because they were able to go back into the community and raise more capital. And why? Because they had community support. They also had a team on their board and on the staff if they were already open could support that and who would. And then those that weren't able to do that or did it sort of partially, they didn't get enough cash to keep going when they hit tough times. So that would be another piece, is really what's your ability, what's your community support and your ability to look to that community if you need trouble. And that's it's not just about dollars, but dollars again are sort of a proxy for it, but dollars are important because that's what's going to help you if you run into trouble.
It's really interesting to me that, so part of, I think sometimes startups used to hearing we're looking for that ownership count, we're looking for that, that strong board, but very specifically because that leads to, it has led to, and lived experience with lenders, to resiliency when things don't go well. So, and we've seen that as well. This specific question, things you'll be looking at besides the market study, do you want to throw any comments, Maggie?
No, I don't. I think I would just echo exactly what Christina said.
Okay. If you're okay, then I was thinking about leading to a conversation about owner capital. That number was already changing and has changed a lot. When I first did an expansion of a startup or food co-op, which basically might as well have been a startup, and Christina was there for that. There was a percentage that was expected to come from owner capital. And when we say owner capital, that includes your owner equity, that includes any owner loans or preferred shares, and it does include free capital, money the grants that now belong to the co-op. And that percentage of the total project that had to come from owner capital has continued to sneak up from a number that actually I won't even say anymore because it would make people sad because they would miss those times. And that was continuing to kind of go up as percentage of the project even before this. What do you expect to impact on that? How much do you think you'll be looking towards? What's the base number now? Is there a number that CDFIs are comfortable saying that work with startups that the percentage of the project they're really going to need the co-op to fund for itself? And I'll talk to first Christina and then Maggie.
Yeah, and I don't think we have a hard number, but it's if it was, it might be scary. I don't we don't have a hard number that I think we're saying as a minimum, but it is. I think we're often talking about nowadays 2/3 of the money coming from a combination of owner capital and or maybe other sources, like if there are sort of city grant programs and other resources like that. Money you're not going to have to repay urgently is really the critical piece, or may not need to repay at all. But I think that number is driven by two things. It's a combination of what are you going to be able to afford to repay, even as you're trying to grow your sales, and even if things get a little tough and you hit some tough pockets, tough times, what could you repay? And that's one measure. That's one number we're looking at. But the other is, sort of how much capital is available out there for startup food co-ops. So if banks aren't doing a lot of startup lending ever, and they certainly are not now in the grocery sector, and the CDFIs have limits. And in fact, the other thing I would add is that as a CDFI, and again, Cooperative Fund in New England and Shared Capital, both as CDFIs, while we have a mission to support co-ops generally and food co-ops very actively, the reality is that our funding is also very much tied to serving communities that are low-income communities of color, low-income communities and communities of color. And so for a food co-op that is not serving those communities, our available capital to provide to a startup project is even more limited. Now that doesn't mean that co-ops should go out and serve communities they weren't intending to serve in order to tap our money, but I think we just have to be realistic about our money is really intended to provide financing into communities where capital access has been limited historically. And while we can go outside of that focus for in a limited way, we have certain responsibilities and reporting obligations to be able to maintain our access to capital. And so all of that by way of saying the money available to startups is limited. And so even if you could repay more, then we may not have as much as you want to borrow.
Okay. Maggie, did you want to add anything? I'm going to take advantage of you since you're here.
No, that's okay. I would say definitely the requests that have been coming in have been larger and larger because the expense of starting up a co-op has gone up and up and up. but it's true, there is limited, even within our funding, what we have that can be lent to co-ops has its limits. And so we do look to co-ops to bring in as much as they can from other ways. And again, for the reason that the less they have to repay, the better it is for their cash flow. You know, sometimes if a co-op can't raise money through other means, we will work with other CDFI lenders to participate in a loan so that none of us has an amount that we're uncomfortable with, but that the amount altogether is probably more than any one of us could envision lending to that particular project. But to do that, I think the underwriting has to be really strong. It has to be a very strong project.
So
I would maybe, if I could piggyback on that, that's
Yep.
exactly right. Meg, we've all worked together on projects where we're trying to make sure there's enough, try to bring enough dollars. And that's, I guess, two things I want to piggyback on. One, your point that back in the day when we were doing a larger percentage of the financing, it was also a much smaller dollar amount. So in some ways, our dollar amounts have gone up, as well as the percentages have gone down because your projects are so expensive. Secondly, I wanted to just add, in Maggie, I think CFNE has also done these projects where sometimes we can help pool together other sources through our CDFIs. So we've pooled dollars from other co-ops who want to support you, or other resources in your community. Can sometimes, as a CDFI, we can help channel those to you. So we, for example, had one project where I think we had 18 different co-ops come together and put small amounts of money in together and use all of that to make a loan to the co-op that was starting. But no one co-op had to put too much in, and they didn't have to manage the servicing of that loan themselves. So there were a lot of advantages. So that's the other resource that we can help with.
So as you're saying this, and maybe you're not, I mean, what I'm hearing a little bit, and I'm not trying to trick you guys into statements that you have to back up, because we know there's a lot you don't know yet. But at the same time, I'm trying to help maybe startups get a clear picture of what they're up against. Traditionally, banks that were not CDFIs, that were not cooperative focused, and were not experienced with co-ops, they ended up being a very small portion of the number of startups that got bank loans wasn't high. Startup food co-ops. And now things are going to get even tighter. Is it a fair statement to say it's probably that maybe, yes, go ahead, approach local banks, especially ones that tend to do a lot of locally focused projects that are commercial, but your chances have just gotten a lot slimmer of actually working with those resources and probably focus more energy elsewhere?
Yeah, I mean, I think it is worth looking at whether they're at local banks, and again, like you said, really critical to look at those that have strong small business lending experience. There's just, I mean, there's a difference between those that know that business and those that don't. And we do occasionally see credit unions, which we'd like to be a bigger resource, are not always well positioned for that because they don't do a lot of commercial lending. Mm-hmm. But we do see some communities where a local credit union will do that. And so look at those. I think, you know, they either can get comfortable with it and point to projects like yours that they've supported, or they can't. And I would say don't invest a lot of time if you don't want to teach them how to do grocery lending or small business lending in their community. It's not going to be worth your time. If they already know that, then talk to them and see if you can get them comfortable with your project. And that a lot of times is about relationships. It's who they know. And I don't know, Maggie, if you have any other thoughts on that.
The only thing I would add is that I think sometimes when a CDFI has come in as the first lender, that gives some degree of comfort to a local bank to come in, not generally as a subordinate lender. We will often share first position on loans, but having shared capital or LEAF or CFNE come in as a lender will help a bank, a community bank, sort of get over that hump and get to a comfort level with also participating in the loan.
That, Jacqueline, if I can jump in, that's a really good point, Maggie. And I just want to even build on that too, that if one of the roles, I think sometimes because we're going to give you the bad news of, hey, it's hard for us to come in and do some of these loans, that can mean that folks hold off being in contact with their CDFI loan fund. And in fact, I think we still want to talk early. We may send you back to do a whole lot of more work, but at least we know about your project and we're tracking it. The other reason I want to say that is exactly as Maggie touched on. Sometimes we can step in with a commitment that is contingent on other money coming to the table. So if you're talking to a local bank and they're trying to get their head around this, but they don't quite get co-ops, they like the people, but they don't quite get co-ops, or you're talking to the city about city resources, or you're talking to other community or community resources, we can sometimes come forward and get you an approval if you've got a strong project and say, we could approve up to this much if you get these other sources lined up. And we have done that, and what that can offer you is you can then go to the city and say, look, if you approve this grant, or you approve this loan through your community development program, or the local bank, we can also talk to the local bank and try and help them understand your financial statements, which they may not fully understand because they don't work with co-ops very often. So those can be roles we can play, and mean that you need to be talking to the loan funds early, even though you may be trying to get all of your kind of ducks in a row before you want to talk to them. In fact, it may be helpful to have that conversation earlier so that you can see what other resources we can help you leverage that can make it possible for us to be in the project too.
So that leads me to some questions about strong projects. You guys said, some of the things you're looking for. So I'll say this, so you guys don't have to say it. There's not a lot of wiggle room in what a strong startup food co-op project is and isn't. Feasibility is real, and it has to be there. And feasibility includes internal capacity, that you've been able to keep that board moving, that ownership growth, so forth. And I would encourage you all, because sometimes we come out of these and everyone's like, oh, these lenders, they lend to food co-ops and they're going to help us find the rest of the lenders. They can't lend to every project. Not every project has really decent feasibility. And I think facing what's going on with your feasibility sooner, and if you have the comfort, sharing what you do have so far about your market, about what you're hoping to do, maybe your early performer work with a cooperative lender, with a CDFI, and be able to say, like, can you ask for truthful feedback? Ask for truthful feedback about whether this is looking like a strong project, if this is looking like the kind of projects that they are looking for. It's tough to ask for that blunt feedback, and you're not probably going to fully get it from a CDFI lender nor FCI unless you really, really, really ask for it and say, no, really, I'm willing to hear, where are the weaknesses, where are the concerns. You're going to get but if you want really like this and this and this would have to change probably. These are for us to be able to be serious about this project. I would strongly recommend having that, giving them the freedom to be that honest with you. Because I think we do know that pretty early on what's looking, stronger and what's not, and not every project will get funded. That was me talking, not them. I'm going to go back to asking you guys questions. But I do think there's a strong sense of right now, CDFI lenders are going to be more important to startups than ever because the banks are going to be even less willing. And so that leads to the question about, is the number of startups that are organizing nationally is down a little bit in the last 3 years. So we're down from like 125 on average to more like 100, 110 on average organizing around the country. So it's slowed down a little, but still there's quite a few of them out there. What's a reasonable, how many projects do you actually work with in startup food co-ops per year? Like what's reasonable? You guys can't fund absolutely all of them, and certainly they're not coming at once, but anything you can speak to about that, just about the capacity within your organizations and how many startups you really can work with.
That's a great question. There's not, one of the challenges and one of the reasons folks may feel like they get kind of wishy-washy answers is because one of our strengths is that we don't have hard formulas that completely restrict what we do. So the upside is we have some ability to be creative, and we've been joking about, can we just call ourselves craft lenders so we can kind of hop on board with all these other sort of, because each project is really kind of, we have to kind of work through and understand the nuances and try and figure out how to mitigate risks. But so unlike some banks that may have like, these are the hard ratios. If you're below those, we're not going to talk to you. Ours is not that rigid. That said, I guess, it's really realistically, we're probably not lending to more than 1 or 2 startups a year. And the other component of that is that projects, we're often having to make commitments a year or two before the project is going to open doors. And then often the timing is uncertain. So we're also trying to make sure that they're not all going to, that we're kind of working with, one or two at a time, honestly, unfortunately. I mean, I think we'd love to have the resources and the staffing and resources and flexibility of dollars that would allow us to do more than that, because we obviously believe in the work you all are doing, but we're looking for the top 1 or 2 projects a year. I don't know, Maggie, you're a little bit bigger than we are. You might have more, I don't know what your numbers are.
Well, we're a slightly larger fund, but with a substantially smaller geographic area that we cover. As far as I know, at this point, if we have a solid application, we will entertain an application from any startup in New England whenever they come across our desks, because the numbers are just not that big in New England. But so Christina, I'd be curious, how many applications do you get a year from startup food co-ops?
I mean, a lot fewer now than a few years ago. They definitely have slowed down. That's a great question. We're only getting a few. I mean, we don't turn down a lot of loans. We probably approve 80-some% of our loans because we're working with the co-op to try and get to a yes. But that means that we're often trying to head off projects we don't think are feasible early on. You can always still apply, and we will give you a thorough review if you decide to apply despite our recommendations, but we're often saying to the co-op early on, this just isn't likely to be approved. Our team is trying to really give that feedback early on, or unless you do X, Y, and Z, it's not likely to be approved, and therefore, I guess the other thing I would add, and I guess this gets back to something I said earlier, we're really looking for most of the startup projects that we're going to finance to be in low-income census tracts that have high poverty rates, high unemployment rates, and low median income. And that I realize that is not, I mean, the co-op should never make the decision about where to be located in order to access our financing, because that might not be the right place. But sometimes the decision of one location to another could be a difference. It's a tricky, I definitely don't ever want a co-op to choose a location based on where they think they could get access to financing from us. But if they aren't in a low-income census tract, it is very possible that even a strong project we may have to turn away just because we have to focus most of our dollars in those communities. But I guess the one other thing I would say is that it's often, unless you're looking at the census data, you may not know if you're in a low-income census tract, because the way the government slices and dices their community census tract, I mean, the way that it looks at the data is often confusing. And so we've often worked with co-ops who may think they're in a middle-income area, and in fact, according to government statistics, they qualify. So I'd say, let us run that through the geocoding site and see if you are before you decide whether whether it works or not.
I would also say it's actually easy to find that geocoding site through Google search. And you can look at, because I was going to say, you guys often misguess. Again, like my home co-op is in a low-income C-to-5 tract. I would not have guessed that, but it is. And the other hand, I've seen a lot of you say, oh, we're kind of a low-income blue-collar community, and you run through that census tract and it does not agree with you that is the case. So it doesn't really matter what our emotional opinions or impressions of our community are. I know that our sense of our communities are very important in our development work, but this is one place it's not up to us. So there is a CDFI zone map out there that you can run for your community and see if you qualify. We use it all the time. So if you don't even want to bother the lender, we'll run you if you'd like and find out. So they don't really have to, it's a lot to ask of a lender you're not working with yet. So feel free to ask SCI to send you the link or to just run you and we can find out. So, but it is important to find out. Christina's right. You might be completely surprised. And it's good to know now you guys do sometimes lend to projects that are not within CDFI zones, or is that kind of a never?
No, we do, and it's just that we have to manage the percentage of our dollars on an annual basis that go to those projects, and so it depends on what else is in our what else is coming to us over, and you and we have limited control over that, so it's a little bit arbitrary. And we were just talking about a project that's in a community that is not in a qualifying area. And it would otherwise be a project we'd like to work on, but we, realistically, just given our other commitments, are looking at and saying we probably can't. Let's see if we can get them to somebody else who could work with them, but we probably can't.
Okay. So it doesn't rule you out if you're not a CDFI zone, but it's really good to know now because it's going to affect your lending picture pretty majorly, I think is what I'm hearing. So.
Yeah, and yet don't, choose where you think you need to be and what's right for your community. But unfortunately, increasingly over the last 10 years, market studies have steered co-ops into addresses that don't qualify because you're looking for adequate income to support purchases of groceries, but that there is a little bit of a conflict there for us as we that I don't know that that's a bigger picture to solve than one grocery project, one startup project can solve. But there is this sort of it's been a long week already. It's Tuesday, right?
Okay. You guys can keep throwing questions in the comments if you want. Like, is there something that I haven't covered or something that I haven't covered? I mean, we've still got a good 10 minutes here, but I want to make sure that I haven't taken you way off of some topic you wanted to hit upon, Christina. Or should I just keep peppering you with questions?
No, I think keep peppering questions. I think you've covered the things I was thinking about.
Okay. All right. So folks shouldn't expect, so what I'm really kind of hearing is so far the analysis you all are doing of what startups you can work with and how many hasn't majorly changed. I mean, again, it's been a couple months. And we already knew that market studies were important, but also less of an indicator than they used to be. Overall, does that sound accurate? We don't expect major changes in how we look at those projects, or we just don't know what they're going to be yet, but we expect changes to be coming and start for looking at startup food clubs?
That's a great question. I mean, market studies are still really, there's nothing to replace the market studies, even though we know they're inadequate. So I think what's happened is that market studies are as important as ever, and we now know we can't rely on them as much. That means we have to try and use a lot of uncertain information around them. So that's actually a worse place because it means there isn't anything to replace it, and we're guessing just like you are, right? Or maybe more. We're trying to do the best we can with using our historical experience and the co-ops around us. And I think in terms of COVID, I think that one of the things we'd be looking for, from an existing co-op, we'd be looking for how do you adapt during this period. I think from a startup, maybe we're looking at are you taking in information from how the COVID situation impacted other co-ops who are operating and learning from that to see how you put plans in place, whether it's adjusting your you may need to be able to deliver curbside pickup, or maybe you can't. I mean, what are you taking away from this experience and learning and adapting your service mix, your service kind of delivery and plans? Also, how are you thinking about crisis planning? Because I think that's if there's anything that this experience has told all of us is that none of us were adequately prepared for this kind of a situation. So, but those who were more prepared survived it more easily than those who not. So what are you doing around crisis planning? What are you doing around, what lessons are you taking away so that even before you open your doors, you're already learning from the experiences of other co-ops? I think it's nothing more concrete that I can think of, because we're just like, are you learning? Are you figuring this out? In many ways, while we work with a lot of food co-ops, we're not in the grocery business ourselves. We're in the lending business. And so we try to understand the grocery business as best we can because we're committed to working with grocery co-ops, but we're still trying, it isn't our area of expertise. It isn't our business line is what I guess I want to say. It isn't our line of business.
I have a thought I want to add to that, but Maggie, anything you want to add to that about what might be changing about how you look at these loans since COVID-19, or if you expect to basically use the same criteria?
I think we're basically using the same criteria. I think we're doing what Christina's doing at Shared Capital, and for startups, we're with existing borrowers or existing co-ops, we're definitely asking in their application for a piece on how have they adapted to COVID-19 and how do they see that affecting their business plan going forward. I think asking startups what have you learned from the rest of the industry? How is your business plan changed so that you are prepared to deal with a crisis? I think another thing is sort of, do we see people availing themselves of FCI in New England, of the neighboring food co-op association? Are they sort of trying their best to stay current and engaged with their peers, even as a startup or with practicing stores, so that they're in a position to learn? And it goes back to, I think, what Christina said about having a learning culture in your organizing team and not being afraid to ask people questions and take advice from other folks. I think that's hugely important.
Yes, yes,
So
the ability
one
to
other
take
thing,
advice.
while we haven't, I'm sorry,
Yeah.
Jacqueline, but one other thing, while we haven't implemented this, the only other thing is, I think, what I would add is, as I was trying to think about this, is I think we probably want to see more cash on hand to start than we even did
That's
before.
what I was going to ask you about next.
So yeah. Yeah.
I would say if Dami was, so Damiano from National Cooperative Bank, if he were here, I know the thing he would have said to your, you need to be more crisis prepared. He would have said, what I need is more cash. And so what I'm going to say here is, a lot of you come to me with your pro formas in 2B. So let's have this out. You bring, and you're like, why do we have to have an overrun this high? If the overrun was not this big, we could get it, this would be so much more financeable. That I have like 10% of the entire project sitting here in a cash hole, and I have to finance it because the lenders want me to finance it just in case. Let me tell you now, you can stop asking me that question. It's no longer even vaguely negotiable. That overrun is there because unexpected things do happen, and I can give you lots of examples. But if it doesn't, you now have this additional cash cushion, and it has seen through co-ops that did not open with the sales they expected and helped them survive while they got their game together, while others went under because they didn't have it. So that's where a lot of your extra cash is also hiding, is if you can keep that overrun. And I know the National Cooperative Bank has even gotten to the point where they're having startups escrow a large chunk of cash that you're not allowed to touch without the bank's permission. And if you get into a crisis, then they can make decisions about whether you have a good enough plan that they can release the cash because you're going to use it responsibly to get out of your crisis. So you're going to see a lot of conversations around overruns and cash. And for those of you who keep asking me, can we take those numbers down? The answer will absolutely be no. I'm pretty much willing to say that, although I'll let Maggie or Christina disagree with me if they think so.
No, you're absolutely right. That is 95% of the startups that have run into serious problems has been cash. Cash would have been the solution, and not having enough was very much part of the problem. So absolutely essential. And I mean, that is one of the things that we are looking at, but aren't yet consistently requiring. But is those kind of cash escrows like the bank does, because what ensures that cash we required you to have on hand at the start? What ensures that's there if a crisis comes along? And we'd like to just all trust each other, but sometimes that money gets eaten up for things that shouldn't have. And, so we're trying to find, because it feels like a heavy-handed method. Banks use it all the time. For us as a CDFI, it can feel heavy-handed. And so trying to find ways to maybe have, balance requirements, things we're trying to figure exactly the best mechanisms, I guess, out.
And South Philly, Lori commented, and I blurred that. So you've got your working capital, which will be a line on your pro forma. And then I'm talking about, in addition, that overrun groups that are in 2B that still don't have actual quotes for the costs of things and stuff, and they want to take it down. But that's not a good move right now. It's kind of, to protect yourself. But yes, so working capital will need to be solid and possibly higher than previously, and there's this discussion of escrowing some of it. And I'm just going to say, someone who's been on the side of being a borrower as a co-op, that these things sound awful. Like, it's like, you want to escrow my cash? Like, oh my God. And there are and they want, if they ask you to do that, it's because they want you to survive, and they've seen it. We've actually seen startups that basically, during the phase where you're paying to build it out, the GM has burnt through or the project manager a whole bunch of cash that was supposed to stay in cash, and they just spent it. And there's no way to catch that until after it happens, because it's happening very, very rapidly. So some of these things are being put in place to make checks and balances to make sure actually that exactly what you said you wanted to happen is what happens, so the co-op stays safe. So I wanted to put that out there, that sometimes we get into these feeling of, what am I looking for? Of a kind of antagonism almost, us the lender, if they just wouldn't expect this, if they just wouldn't expect that. I will tell you now that I've experienced lending from all different kinds of lenders, that nobody is on your team like a CDFI. They will spend more time educating you, training you, telling you the truth, helping you find solutions, helping you find partners. So if they're pushing for stuff, trust me, no one else is going to lend to you if you don't do it. So try to be open to what they want to share with you. Before we wrap up, any last thoughts that you wanted to share, Christina?
No, I mean, I guess just to say, I think we continue to think that grocery co-ops are just such an important opportunity for communities, but in terms of bringing your control over the food you want to have in your community, having grocery stores that are responsive to the community. So we want to support you and find ways to make sure you can get running. And so thank you for the work you're doing, and I think we have to continue to work to find ways to kind of respond to make sure that projects that have a strong likelihood of feasibility can get the financing they need. And I think that's where, as part of the co-op community, I think we can continue to try and figure that out. It's been a lot of uncertainty for a number of years that has made that challenging, but let's continue those conversations. And thanks for the work you're doing.
Thank you. And I want to point out to those of you, if you haven't paid attention to the chat, I didn't have a chance to take advantage of Don Moffitt and his wisdom while he was on this call. We really wanted to focus on the lenders, and there was enough to talk about. I was going to see if I could pull him in, but he's put some useful information in the chat as well about overruns, about working capital, and please, take a look at that. I apologize I wasn't able to utilize him during this call. I want to take a moment and really thank Christina for making the time to be here at a difficult time. Super appreciate it. And for Maggie for becoming our unofficial backup. That was awesome. Thank you very much.
Glad to have you, Maggie.
And
I wanted to hear what Christina was going to say, and I've been thinking of calling. We think of calling the other CDFIs that we work with a lot. It doesn't always happen, so this was a great opportunity for me.
Excellent. And I will say, for what it's worth, if you're in the New England area, call Maggie. Their team is really awesome. I mean, Maggie is just terrific to work with and answering questions and stuff. So yeah, if you're not already working with them, please, you have an amazing resource in the Northeast. Please get a hold of them. I do want to make sure everyone's aware of what's coming up next. So tomorrow at 1 p.m., we have a session on curbside delivery and pickup with Michelle Schrei from National Cooperative Grocers, just for you. We actually asked her this session, and then she called me a week later. She goes, did you talk to CCMA? Because now they want the same session. So CCMA is that, and I hadn't, but CCMA will have that session today. If you're attending CCMA, it will be aimed at open co-ops, but it'll be very educational. Tomorrow, she's coming to our COVIDeo series to talk to startups and let us ask questions from a startup perspective, how she thinks is going to impact startups, what changes she would recommend for you, that sort of thing. So if you can see today's at CCMA and tomorrow's, it'd be particularly awesome, but she's going to be here doing that. Friday, we thought this Friday would be the end of the COVIDeo series, and we had a session, and we're not canceling it, called The Big Picture, and this will be the FCI team. Michael is going to be here talking about what she's seeing. She's our Director of Development and grants and loans, or grants and donations, and what's going on there, some information that might be useful. I'll be sharing all about what we've been learning about business feasibility and organizing, and Stuart will also be here talking about business feasibility, kind of just trying to give an overview picture of what we know and what we're seeing so far since COVID-19 that might affect startups. So we hope you'll join us for that on Friday at 1 p.m. Central Time. And then next week, because it didn't quite end, we have our Board Chair Confidential on Tuesday. You guys wanted to talk about accountability in the age of long distance meetings and store design. I'm really excited. Seven Roots, Nicole Klimek is going to be here along with Kevin O'Donnell, to talk about, they're already designing stores different based on what happened with COVID-19. And they're going to go over how already, what's different and what you can expect to be different when you have a store. If you're not a member yet of our Startup Food Co-op Boards discussion group in Facebook, that's where all the news and information goes out. We have some great conversations, and we have a survey up there right now trying to find out what you guys want post COVID-19 if you want to continue to have some ways to interact via video. So thanks again to Christina from Share Capital Cooperative and to Maggie Cohn for the assist, and have a wonderful day, everybody.
Thank you.
Thanks.